What is tax loss harvesting? Well, tax loss harvesting is a Canadian tax strategy that allows investors to sell investments to trigger capital losses and apply those losses against capital gains from current or the previous 3 years. This allows investors to recover taxes paid previously on capital gains. So, how does it work? To provide an example of how this might work in practice, let's look at the graphic below. In 2020, an investor sold an investment, stock, real estate, or business, for a gain of $50,000. Assuming they are in a 50% tax bracket, the capital gain was taxed at 25% that year, and the investor paid tax of $12,500. If that gain is left untouched for 3 years, that money is no longer in their pocket, but is permanently in the hands of the CRA. In 2022, that same investor has a portfolio with $200,000 invested in stocks. This year has been marked with largely negative returns in the markets as we recover from COVID. Therefore, their portfolio has declined in value by 20% and now holds stocks that have lost on paper $40,000. The investor can now sell those stocks to trigger capital losses. If $40,000 of losses were triggered, the investor can report those losses on their 2022 income tax return, and they will receive a refund of $10,000. If the loss that is triggered is greater than $50,000, the tax paid will be totally recovered, and the excess can be carried forward indefinitely and applied to future capital gains. If it is less than $50,000, as in our example, the investor has through to the end of 2023 to trigger additional losses to recover any tax paid on the capital gain. In the case above, the investor can reinvest in any other investment than the original stock sold, or they can buy back the stocks sold after 30 days without triggering what is called superficial losses. In this case, the investor has $160,000 to invest today and another $10,000 when they receive their tax refund in 2023. So they have trimmed their losses from $40,000 to $30,000 thanks to tax loss harvesting. What is the advantage for you? Tax loss harvesting is a powerful tool that can help reduce a person's overall tax burden. While tax loss harvesting may not restore an investor to their previous position, it can lessen the severity of the loss if the strategy is applied correctly and in appropriate situations. This is particularly important this year when the public equity markets have been underperforming. There are a few key factors that need to be considered when looking at this strategy. According to the CRA's superficial loss rule, investors claiming a capital loss may not repurchase the same investment within 30 days of the sale. This is to prevent investors from playing the system to lower income tax. Additionally, it is important to note the investor's spouse would also be unable to repurchase the same asset within 30 days. Tax loss harvesting only applies to investments sold in non-registered accounts. Capital gains inside registered accounts, such as an RSP or a TFSA, are tax exempt, and thus there is no benefit in using the tax loss harvest rules, as the loss could not be used to offset any gains. It is important to review options for tax loss harvesting prior to the end of the year. To offset gains realized in a calendar year, losses must also be settled within that same year. November and December are excellent times to review your portfolio for tax loss harvesting opportunities. When considering the use of tax loss harvesting, it is important to consult with your accountant and wealth advisor to understand the options available to you and come to the best strategy to meet your individual needs. Thank you for watching, and as always, if you have any questions regarding your individual situation, please don't hesitate to contact a Wealth Stewards advisor.